Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stock picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available at our site, TradingPennies.com. This week's chart is Stemcells Incorporated, ticker symbol STEM, a biotechnology company within the healthcare sector. What caught our attention in the stock was a double cup and handle pattern that was forming in the stock within the recently uptrending healthcare sector. As noted in our manual, How Professionals Trade the Penny Stock Market, cup and handle patterns are some of the most profitable and predictable patterns to trade, and seeing this forming in Stemcells Incorporated placed it on our watch list of potential breakout stocks. In review, a cup and handle pattern is formed from a prior breakout. The high of the breakout forms the left side rim of the cup. As the stock pulls back, it forms the left side of the cup. During this period, it is likely that there will be increased volatility, in other words, a greater range among the highs and the lows in volume in whatever time frame you trade. As volatility decreases, the stock begins to form a base. It is important that the lows of the base do not exceed 50% of the prior breakout range from the low to the high that formed the left side rim of the cup. A break of this increases the likelihood of failure of the pattern. The right side of the cup is formed by a gradual increase in price that does so on lower volatility and volume. The rim of the right side of the cup is formed slightly below, at, or slightly above the high that formed the left side. From here we look for the formation of a handle. A proper handle is formed when the stock pulls back on lighter volume and decreasing volatility, and the low of the handle does not exceed 50% retracement of the low of the cup base to the handle high. With this in mind, our buy-in point will be a break of the handle high on accompanying significant volume during a period of the day which is not subject to head fakes. If you have any questions regarding head fakes, please refer to our manual. Once in a position, our attention turns to exit strategies. As noted in our manual, a profit's only realized should you sell your position at a higher level than which you entered. To this end, we will look at some of the following. Pattern projections. The development of a pattern over time in which it develops tends to project into the future its target. In the case of a cup and handle pattern, if one takes the range between the low and the high of the previous breakout and add that range to the low of the cup, the high of that range predicts the next future target and a good place to consider taking profits. Another thing we look at is the intraday ascending 200 moving average. On an intraday basis, we like to use this as our moving stop loss, providing the following rules. If it is broken with 2 consecutive candles in whatever time frame you use, we use this as an indication that the trend is changing and it's a good place to take profits exiting our position. If it is broken on significant volume during a single candle, we view this as a warning sign and will quickly look to any other confirmation signals to exit. Strong overhead resistance. Here we look to multiple time frame analysis to determine points of resistance where selling can be expected. Prior price levels, significant moving averages such as the 20, the 50, and the 200 moving average, trend lines, etc. in multiple time frames have to be considered as traders utilize each relative to the time period they favor trading within. Price volume climax. If the price and volume dramatically increase such that there is significant separation in price between it and the rising 200 moving average, particularly if accompanied by other noting exiting points, we look to take profits and look for the next opportunity. Our experience has shown that in the face of a volume climax, the stock is damaged and will need time before it is considered a potential play again. With that, let's look at Stemcells Incorporated. If you look at the intraday chart, approximately a month ago, Stemcells Incorporated broke out of a consolidation and moved into a new high, forming what would be the left side rim of a cup. The stock pulled back and began to consolidate, forming the base of the cup. You will notice that the low of the cup remained above the 50% retracement of the low and the high of the previous breakout. From there, the stock decreased in volatility and began to ascend on low volume, which is a good sign indicating quiet accumulation. It formed the right side high of the cup, which is known as a handle, on Friday morning, at a point slightly below the prior high of the left side of the cup. You'll notice that the accompanying pullback which formed the handle did so, consolidating above the ascending intraday moving average. At this point, we were looking to take position should the handle high be breached on accompanying volume. We didn't have to wait long. We took position as volume came into the stock a little after 10:30 a.m. From here, our attention was on exit strategies. Utilizing that previously mentioned, our first target was approximately about the 170 range. We based this on pattern projection and overhead resistance on multiple time frame analysis. As the stock moved to these levels, we began to feather out of our position, the bulk of our position anyway, reducing it by about 50%. We held on to the remainder, using our previous entry as our stop loss point, utilizing the 20% gain we had made, and it was the house's money for future profit. Over the course of the next week, this level was tested on 2 occasions. As it was, we saw what could be the development of another longer period cup and handle forming. Using the advance of the prior cup's low of the base to the breakout high, we noticed that the test of the prior handle breakout, where we initially took position, was forming the left side of another cup. The retest on descending volatility formed the base of this new cup, which did not breach our rules of 50% retracement. As the stock began to ascend on lower volume, it formed a high slightly below the previous breakout high. Once again, this stock made our watch list as we looked for the classic handle to be formed. We weren't disappointed. Last Tuesday, the stock opened and consolidated above the rising intraday 200 moving average, forming the classic handle. We were ready to re-enter our position on a volume breakout of this handle high, which occurred shortly after. Once again, we went into exit mode. The stock continued to consolidate and move upwards along the ascending intraday 200 moving average without breaching on 2 consecutive candles within our trading time frame. In this case, we were using the intraday 3-minute period. Prior to Friday's open, news was released that the FDA had cleared the way for Geron Corp to conduct the first human trial of embryonic stem cell treatment. As noted in our manual, news releases are great events to take advantage of dumb money. Being that we were holding position, we looked to exit our position into the anticipated volume accompanying the news event. We did so for a good 50% return. Had you not seen this, there were a number of breaks of our rules for exit strategies. Look at the price volume explosion that occurred at the open. It went vertical, leaving the ascending 200 moving average in the dust, the classic volume climax. Look at the overhead resistance levels at various multiple time frames. The underside of the 50 moving average on the monthly chart, the underside of the 200 moving average on the weekly chart, and also if you took a look on the daily chart, we were reaching a previous price high. All of these occurring at about the same price point. What else could you do but exit your position with all these things standing in your way? Lastly, as the stock pulled back, it broke the ascending 200 intraday moving average on 2 successive candles within a 3-minute period, and the pullback exceeded 50% retracement of the range expansions of the low to the high of the breakout. If this doesn't spell get out of your position, we don't know what else will. In our opinion, this stock is now damaged in the short term, and we're removing it from our watch list until it pulls back to about the 150 level. If you're currently holding position, it is our opinion that you should use whatever strength it has to reduce it or exit your position in the short term. Until next week, from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market. Take care.